What is up, guys and girls, and welcome to DecDoesInvesting, the wealth, investing and finance channel. Before we start, I'd like to ask you to hit the subscribe button to join me on my journey, and also hit the like button to help me out with the YouTube algorithm. In today's video, I have a stock from the US this time, which could be a great buy for growth in the future. In this video, I'll give you some background on the company, and then give you some reasonings and also some analysis as to why I think this stock is a buy now. However, I'd like to point out that this video was just for entertainment purposes only and should not be taken as financial advice. As always, do your own research before purchasing any stocks, as your capital will be at risk. So the stock I'm going to be covering in this video is Accenture, with the ticker symbol ACN, and is traded on the New York Stock Exchange. So taken off their website, Accenture described themselves as a leading global professional service company, providing a broad range of services in strategy and consulting, interactive technologies and operations, with digital capabilities across all of these services. They combined unmatched experience and specialised capabilities across more than 40 different industries, powered by the world's largest network of advanced technology and intelligent operation centres. With 509,000 people serving clients in 120 countries, Accenture brings continuous innovation to help their clients improve their performance and create lasting value across their enterprises. If we take a look at the one-year chart of Accenture, we can see that it was trading at its 52-week high of $215.92 before the pandemic and crashing to as low as $143 back in March. It has since recovered, and at the time of making this video, Accenture is trading at $199 per share. Taking a look at shareholder returns now, we can see that over a 5-year period, Accenture has returned 122.4% if we include their dividends, which is in line with its industry of 121.4%. However, over double that of the market, which returned 56.1% over the same time period. Simply Wall Street and their analysts currently overvalue Accenture by 24.3%, in which they give it a fair value of $160.69, which is calculated on the cash flows the company is expected to generate in the future. Looking at this value a little bit more, we can see that it's currently trading at a PE ratio of 25.6, which is smaller than its industry, which is trading at a PE ratio of 27.1, meaning there is some good value to have in comparison to its industry. However, it is considered overvalued in comparison to the market, which is trading at a PE ratio of 16.2. If we take a look at Accenture's forecasted annual earnings growth, we can see that it's expected to grow 6.4%, whereas the industry average and also the market is expected to massively outperform this, growing 25% and 22.5% respectively. This is also reflected in their forecasted annual revenue growth, in which Accenture is expected to grow 5.5%, whereas its industry average is expected to grow 10.9%, and the market is expected to grow 8.9%. Moving on to the past earnings growth analysis of Accenture, we can see that over the past 5 years, it grew its earnings by 8.8%, which lagged the industry average of 9.5%, and also the market of 13.6%. Over the past year, Accenture did beat the market, which only saw a return of 1.1%. However, the 11.1% return of Accenture was beaten on average by its industry, which saw a return of 15.4%. However, looking at Accenture's earnings and revenue as a whole now on a graph, we can see that they've been on a steady rise. And as of February 2020, we can see that it posted a profit of $4.9 billion, which was an improvement upon last year. Moving on to its financial health now, we can see that it boasts a very strong financial position, in which its short-term liabilities of $11.2 billion and long-term liabilities of $6.4 billion are well covered by its short-term assets. If we now assess the debt and equity of Accenture, we can see that it has equity of $15.92 billion, which has been on the rise year on year, and debt of $19.88 million as of February 2020. This means that it has an almost non-existent debt-to-equity ratio of 0.1%, which is easily covered by its operational cash flow, which is a great thing to see during times of financial difficulty, just like we're finding ourselves in now, as it's highly unlikely that the company will go under. Finally, to wrap up Accenture, we will have a look at its dividend yield, in which it currently has a yield of 1.6%, which is greater than its industry average of 1.3%. However, it does find itself paying a lower dividend yield than the lowest paying 25% dividend companies. Also, this yield is only expected to rise to 1.7% over the next 3 years. Moving on to the growth and stability of this dividend, we can see that it currently pays a dividend of $3.20 per share, which has been paid and also grown for the past 10 years, which is great for dividend growth investing as it aids in the compounding effect. And finally, looking at how well this dividend is covered and the safety of this dividend, we can see that it has a current payout ratio of 31%, which is forecasted to rise to 44% over the next 3 years. I'd like to point out that this is a decent payout ratio, as the dividends are well covered by their earnings. But also at this level, there is plenty of room for growth in the future. So that wraps up this video and analysis on Accenture. Please let me know down below your thoughts and views on my stock pick and whether or not you'd buy them yourselves. So if you've liked the video, please drop it a like, subscribe if you want to see more videos like this, and if you've missed any previous updates, there will be a link to the playlist in the description down below, along with some other videos that you may find of interest. And until next time, peace.